All right, to continue here with the carry trade, as I said before, the carry trade is basically an unhedged trade. It basically it will work assuming a violation of uncovered interest rate parity, and also that the markets are not very volatile. Now here's the idea. Usually the way the carry trade works is you have, let's say, an emerging market currency and you have a developed market currency. And usually the developed market currency, because it's more stable, will have a lower interest rate. And the emerging market currency, because it's generally speaking more volatile, it will be a higher interest rate. And what we can do basically is we can borrow in the low interest rate currency in the developed markets and then invest in the higher interest rate currency, which is the emerging market, just as an example. Now the idea is because the emerging market currency has a higher interest rate, okay, it has a higher interest rate, and we're assuming again that the markets are well integrated, that emerging market currency should do what? Should depreciate relative to the developed market currency. Now, so the emerging market currency will trade at a forward discount, if you will. The foreign currency, the emerging market currency, will be trading at a forward discount to the developed market currency, and as implied by the forward premium or discount. And what will happen is a carry trade will provide you with a gain if your expectations are different from the marketplace. Again, what is the marketplace? The implied forward discount in my example. If the market believes that the emerging market currency is going to depreciate by, let's say, 5%, and you believe that the emerging market currency is going to depreciate by less than 5% or actually appreciate, and it actually does, and your expectations materialize, you will have a profit on your carry trade. When will the carry trade work against you? Or when will you actually have a loss, and when could you actually lose your shirt? You can lose your shirt, or you can lose if you decide that the emerging market currency, the higher interest rate currency, is going to depreciate less than is implied by the forward discount, but in reality it depreciates a lot more. Over time it depreciates a lot more than was implied by the forward discount. Then obviously that currency, that emerging market currency, is depreciating much more than was anticipated by the marketplace or you, so you will therefore have a loss on your carry trade. And if it depreciates a lot, that emerging market currency, you can actually lose your shirt. That is why we say that the carry trade should be executed or can be profitable generally in more stable market environments or stable currency environments, not where there's a lot of, if you will, volatility. Because a lot of volatility, especially with emerging market currencies, could cause them to depreciate a lot more than the market's expectation is, and therefore you can actually lose on your carry trade. So let's take a look at this actual example here that I have on the screen for you in terms of a carry trade so you can see how it works out. Let's say the spot exchange rate is 3.75 Saudi riyals per dollar. I'm using the Saudi riyal here as the emerging market currency. In the real world, and if you're watching this in Saudi Arabia, it's a pegged currency. The Saudi riyal is pretty much pegged against the dollar, but I just decided to treat it as a floating currency here. But in any case, the spot exchange rate between the dollar and the riyal is 3.75 Saudi riyals per dollar. The interest rates are 5% in Saudi Arabia and 1% in the US. Right off the bat, you should see that the interest rates are higher in Saudi Arabia by 4%, so the market is going to expect that the Saudi riyal will depreciate by 4%. That would be the implied forward discount on the Saudi Arabian riyal. But we'll get to there in a second. Question number 1 on your screen says, determine the 1-year forward exchange rate for the Saudi riyal, because of course those interest rates are annualized interest rates. Question number 2, demonstrate the steps to create the carry trade. Question number 3, on what theory is the carry trade based? Number 4, calculate the profit or loss on the carry trade if the spot exchange rate remains unchanged and the trade is created by borrowing 1,000 units. Now I told you 1,000 units here because I didn't want to tell you whether it's dollars or reals. And then show your work. And what is the primary risk is question number 5 of this trade. Well, let's first of all determine the 1-year forward exchange rate for the Saudi riyal. How would we do that? Forward, I gave you the formula already. Forward equals spot times 1 plus the domestic interest rate over 1 plus the foreign interest rate. So if we go to the next page, we see the answers. The next screen, you will see number 1, that it says 3.75 Saudi riyals per dollar, that's a spot exchange rate, times the interest rates in each country. Keep them consistent. Since it's riyal over dollars, it'll be the riyal interest rate over the US interest rate, 1.05 over 1.01 to the first, and that would give you 3.9 Saudi riyals per dollar. So as you can see, from a dollar perspective, you're expected to get more riyals for your dollar. So the dollar is appreciating and the Saudi riyal is depreciating. And the Saudi riyal is expected to depreciate by approximately 4%. Okay, which is equivalent to the interest rate differentials of 5 and 1%. All right, let's go now back to question number 2. Let's go back to the screen with the questions. Question number 2, demonstrate the steps to create the carry trade. Well, what is the market expecting? The market is expecting, as we just saw, based on the forward premier discount, they're expecting the Saudi riyal, which is the foreign currency, which is the base currency, to depreciate by 4%. That is what the market's expectation is. So what can we do here? We always do what? We borrow in the low interest rate currency, which is the US dollar. So step number 1 would be to borrow US dollars at 1%. And then we take those dollars, we convert them to the Saudi riyal at the current spot exchange rate of $3.75 Saudi riyals per dollar. And then we have Saudi riyals, and then we invest those riyals in Saudi Arabia at 5%. Where's the forward transaction? There is no forward contract here. Why? Because it's based on a violation of uncovered interest rate parity. If there's an arbitrage opportunity here, you cannot eliminate it with forward or futures contracts because they don't exist. That's what the theory is saying. All right, so question number 3, on what theory is the carry trade based? It's based on a violation, as I just said, of uncovered interest rate parity. So it'll be profitable if you go to the answer key. Question number 2, I already walked you through those steps, 1, 2, and 3. Okay. And then if we go to question the answer to number 3, as it shows you on the screen, the carry trade is based on a violation of uncovered interest rate parity. And again, I put this FYI or for your information. The carry trade will be profitable to you if the spot exchange rate of the Saudi riyal, because that's the foreign currency, that's the country with the higher interest rate, declines by less than 4%, because that's what's expected by the marketplace. What does it mean that you're expecting it to depreciate less? You're expecting it to appreciate in essence. You're not expecting it to depreciate as much as the market is expecting based on the implied forward discount of 4%. So that is the answer to question number 3. Going back to question number 4, calculate the profit or loss on the carry trade if the spot exchange rate remains unchanged and the trade is created by borrowing a million currency units or a million units. Show your work. Let's do this together. I'm not going to put up the answer key. Let's do this together and work it out. First of all, what are we going to do? We're going to borrow in the low interest rate currency, which is the dollar. So we're going to use dollars. So we're going to borrow $1 million at 1%. Is everybody with me? Good, I can see, great. Okay, $1 million at 1%. So what does that mean we're going to have to pay at the end of the year? We're going to have to return the $1 million plus 1%, which is $10,000. So we're going to have to repay $10,000. So we borrow $1 million at 1%. What are we going to do with the $1 million? Where do we want to invest? We want to invest in the higher interest rate country, which is Saudi Arabia. So we need to convert our $1 million into Saudi riyal at an exchange rate of 3.75 riyals per dollar. When we do that, we will then end up with 3,750,000 Saudi riyals. We're going to take the 3,750,000 riyals that we just did the conversion for, and we're going to invest it in Saudi Arabia at 5% for the year, because that's the interest rate in Saudi Arabia. And at the end of the year, we'll have 3,937,500. Where did I get that? 3,750,000 times 1.05 to the first would give you 3,937,500 Saudi riyals. Then at the end of the year, when we have our 3,937,500 Saudi riyals, we are then going to convert it back. We're not delivering it because there's no forward contract here. We're just delivering it, and we're going to exchange it at the original spot exchange rate because it remained unchanged. And we will convert the 3,937,500 Saudi riyals back into dollars at the exchange rate of 3.75 riyals per dollar. And we'll end up with 1,050,000. What did we start out with? We started out with $1 million. How much did we end up? with $1,050,000. So we have so far a gross profit of $50,000. But then we have to pay back $10,000 additional of interest on the loan in the United States. So we will end up with only $40,000 profit. Net profit would be $40,000. $40,000 net profit on an initial investment of, or borrowing of $1 million is 4%. And again, what is 4%? The difference between the 5 and the 1%, the interest rates. And why is that? Because we expected the spot exchange rate not to change. So therefore we make the full 4%. Obviously, if the Saudi riyal depreciated by 1% or 2% or 3%, we would make less than 4%. But then if the Saudi riyal did what? Depreciated by 10 or 15%, then we would lose our shirts because the market was only expecting a depreciation of the Saudi riyal by 4%. We were expecting it to depreciate by less than 4%. So as long as it's less than 4%, we will have a profit on our carry trade. Now, if you go to the answers, take a look for a second. I set it all up for you with bullet points there. The profit on the carry trade is 4% and how I got all that math.